This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
There are two types of pension scheme that the taxpayer, the individual, may pay into and eventually, when they take their pension, benefit from. And both of these types of pension scheme we've already been introduced to. Now, as we've seen in terms of the income, the earned income that a taxpayer may have, that may be generated either from employment or self-employment. Now, if you are an employee, then employees may have the opportunity to join an occupational scheme. That is what we saw in our employment income chapter, in the previous chapter 9 there, an occupational scheme that has been set up by their employers. Now, not all employers will be big enough or may have the desire to operate their own occupational pension scheme. So if an employer does not operate such, then the employee is left with the provisions of a personal pension scheme that may be arranged by the individual directly with a pension provider. If you are, of course, self-employed, then there's no employer, there's no occupational scheme that you could be a member of. So the self-employed, therefore, have got just one choice. They may choose, if they wish, to join a personal pension scheme. Now, it's viewed by the government and by HMRC that it's a very good idea for individuals to pay into pension schemes and therefore provide for themselves when they are elderly. So to encourage individuals to join the pension scheme, generous tax reliefs indeed have been provided by HMRC, most of which we have already seen, either in the previous chapter, chapter 9 on employment income, when we've looked at occupational pension scheme contributions, and we've seen that with occupational pension scheme contributions, what the employer pays in for the benefit of the employee to the pension fund is an exempt benefit, and what the employee pays into that fund is an allowable deduction against their employment income. What is also paid in by the employer, by the company there, is an allowable deduction for them against their profits in terms of the profit that would then be chargeable to corporation tax. The corporation tax computation, of course, comes along in a later chapter. If we are a member of a personal pension scheme, then back in chapter 2, very early on, when we looked at the income tax computation, we saw there how tax relief would be given so far as your personal pension contributions are concerned. You may recall, I hope, that we said that basic rate relief was given at source. Basic rate 20%, relief given at source. That if you contributed out of your net income, you took out of your bank account and paid in £8,000 into your personal pension fund, then HMRC would credit a further £2,000. The gross amount of the personal pension contribution paid, 8,000 times 100 over 80, 10,000. You put in 8,000, 20/80ths of that, equivalent to the basic rate tax figure on the gross, was given over by HMRC to the pension fund. And then if you were a higher rate taxpayer, you received indeed either higher rate tax relief or thereafter additional tax rate relief by extension of the basic rate band and the higher rate band limits. So all of this in terms of how you get tax relief we have already seen. So thankfully much of this quite small chapter is actually revision. So let's go through those points again. Occupational schemes will always have contributions made into them by the employer. That is a standard part of any occupational scheme. The employer pays in. And it may also have contributions made by the employee. Again, in any exam question you get, you will see this. These are said to be contributory schemes here. The employer will always pay, and usually the employee will contribute as well. Normally the amounts going in are set at some percentage of the gross salary figure. So for example, our taxpayer may have a gross salary of £50,000, and of that then the individual contributes, say, 5%, and the employer maybe contributes another 5%. So in which case in terms of the occupational pension scheme, the contribution made by the employer, 5% of the gross salary 50,000, 5% of 50,000, 2,500. That paid in directly by the employer into the individual's pension fund. That is an exempt benefit so far as the individual is concerned. The individual then makes a contribution, 5% also of his gross salary, that's £2,500, and that will be a deduction from the £50,000 employment income. Now, in terms of the amounts going in, there are no limits on the amount of contribution that may be made by the employer, but they will count towards the employee's so-called annual allowance, the employee's annual allowance. And they also contribute towards the overall value of the fund for when the individual takes out their pension at pension age to the lifetime allowance. So there's two limitations that will be placed in relation to the tax reliefs available on pension contributions and eventually on the pension pot that eventually forms the basis of the pension to be paid when the individual retires. As you pay in year on year, there is an annual limit that will limit effectively the tax relief that the individual gets. And eventually, when the taxpayer takes their pension, there's a lifetime allowance that if the pension fund has grown above that lifetime allowance, there will be additional tax charges over and above that which would normally apply when one takes one's pension. And these we see later in this chapter. Now, these contributions will be tax deductible for the employer. This is the employer contributions, attracting tax relief in the accounting period in which they are paid. Contributions made by the employer are exempt benefits for the employee, as we have said, and though we've mentioned it, we haven't dealt with it yet. That comes up in the next chapter. Any such contributions made by the employer will not be subject to any national insurance contribution payments, but that, as we say, is in our next chapter. Contributions made each tax year by the individual. Now, again, we said there's no limits placed to begin with on what the employer may put into the occupational pension fund on behalf of the employee, though those amounts will contribute towards the so-called annual allowance each year. That will put a limit on the amount of tax relief available in relation to the total pension inputs to that pension fund. Total pension inputs being that put by the employer and that put by the employee. Those contributions by the employer will also, of course, increase the overall value of the pension fund, and that at the time when you take your pension, that will have to be compared with the so-called lifetime allowance. And if the pension fund has grown, as we said, to a figure above that lifetime allowance, then there are additional tax charges. But again, more of that at the end of this chapter. Okay. Contributions made each tax year by an individual into a pension scheme that will attract tax relief are limited to. So, no limitations in terms of what the employer can put in, albeit except by reference to the annual allowance each year. But there are limits placed upon what the employee may put in, and they're limited to the higher of two figures. First one, we'll go to the second figure, £3,600 of gross contribution. Now, contributions made into an occupational pension scheme are made gross. They come out of the taxpayer's gross salary. As we have already reminded you of, contributions made into a personal pension scheme, well, those are paid net. To work out the gross figure, therefore, you'd multiply out the amount actually paid by 100/80. So far as the individual is concerned, we are limiting the contributions made each tax year to the higher of a gross contribution of 3,600. So that therefore is the minimum amount that any taxpayer would be able to contribute into their pension fund. Or, and in any question you get, this is much more likely to be the higher figure, the so-called relevant earnings of the taxpayer. Now, the relevant earnings in the taxpayer in the tax year will be made up of, well, you think, what are the two main sources of earned income? Obviously, if you are in an occupational pension scheme, employment income. And of course, if you're in a personal pension scheme, either employment income and or your trading profits from self-employment. Plus one other that you may or may not remember from Chapter 3 when we dealt with it, any profits, any net income arising from very specifically one type of property, furnished holiday lettings. That too is, for purposes of pension contributions, treated as relevant earnings. But of course, for most taxpayers, it's either, if you're an employee, your employment income; if you're self-employed, it's your trading profit. Those figures will represent the maximum amount of contribution that the individual may be able to make each tax year. As with the case of the employer contributions, if there are any, this amount, the amount paid by the individual, will of course also contribute towards the overall annual allowance permitted each year. And of course, whatever goes in, whether from employer or employee, contributes to the overall amount of pension fund, which again will be looked at in terms of the lifetime allowance when the individual takes their pension at retirement age. Now, where an employee makes a contribution into an occupational scheme, so dealing specifically with an employee, we've said the amount that the employer puts in, as seen in Chapter 9, is an exempt benefit. What the employee puts in will be an allowable deduction against their employment income, again seen in Chapter 9, our previous chapter. Wonderful news. Employer contributions exempt, employee contributions allowable deductions from the employment income. Now, the way in practice that the tax relief is given, it's given at source under the so-called net pay arrangement. Now, this is not going to be a calculation exercise. This would be an explanation exercise in terms of an exam question, where you explain how it is that tax relief is achieved when the individual makes contributions into an occupational pension scheme. The employer will deduct the gross contribution that is made by the employee from the individual's employment income before computing the tax to be deducted under PAYE. Again, back at the end of Chapter 9, the previous chapter, we looked at the pay-as-you-earn system, and that said the amount of pay that would be put through the PAYE system, the tax to be deducted at source by the employer. What happens here we can illustrate in terms of, well, illustration 1. Imagine that our employee has a gross annual salary of £25,000 and wants to contribute £1,000 into his or her occupational pension scheme. The employer over the tax year will therefore deduct from that gross salary £1,000 and pay that into the pension scheme. What will therefore happen in terms of this net pay arrangement? The way you get your tax relief is by never actually being taxed on that £1,000 part of your gross salary, because what the employer will do is to treat the employee as only having an annual salary of £24,000 and putting it through PAYE. So the £1,000 to go to the pension scheme is taken by the employer directly out of the employee's gross salary, and what remains, the so-called net pay, that's where the net comes from this, the gross salary minus the employee's contribution into the pension scheme, it is that is then treated as the salary to go through PAYE. Here, obviously, 24,000. Now, that's the practicality of how the PAYE system works and how you effectively achieve tax relief by never being taxed on that part of your salary in the first place. It is as if there you only ever had a salary of 24,000, not 25. How will we show that in an exam question if asked to prepare the income tax computation? Very simple, as we have seen in Chapter 9. The salary to be included as employment income, 25,000, less the allowable deduction, the contribution by the employee into the occupational scheme, the pension contribution of 1,000, bringing you down to a net employment income of 24,000 that is then a part of your taxable income, and you'll only pay tax on the £24,000. So, two types of pension scheme. Occupational pension scheme, only available to employees whose employers operate such a scheme. Contributions made by the employer will be exempt benefits. Contributions made by the employee will be allowable deductions from their employment income. There are no limits placed on how much can be put into the fund by the employer. There are specific limits on the amount of contributions made by the employee. Here are those limits: the higher of a gross £3,600 or the total of their relevant earnings. In terms of the total pension input, the combination of both what the employer puts in and what the employee puts in, that will count towards the overall annual allowance limit that is permitted each year. And should those contributions exceed the annual allowance limit, then there will be tax consequences. A tax charge known as an annual allowance charge that we see later in this chapter will then arise. More of that though, as we've said, later. We mentioned there about personal pension contributions. Now again, as we have already made mention of, we've seen how it is that the taxpayer gains tax relief in terms of their personal pension contributions. We saw this back in Chapter 2. So when an individual contributes into their personal pension scheme, there are no deductions that feature on the face of the income tax computation. Instead, two things happen. One, basic rate tax relief is given at source. Remember what we said a moment ago: if the individual puts in £8,000 to their personal pension scheme, then their fund is credited with £10,000, the £8,000 coming from the individual and £2,000 paid over by HMRC. Now in this particular note, I've used a rather lower number, but the numbers are still the same basic computations. It pays £800 into pension fund, deemed to be net of basic rate tax at 20%. HMRC will pay the pension provider an amount equivalent to the basic rate tax deduction. That at 20% of gross is 20/80ths of that net figure. It's 200. The overall gross, 1,000. 800 from the employee, 800 from the individual, I should say, whether employee or self-employed. 800 from the individual, 200 from HMRC. So £1,000 is credited, basic rate relief given at source. But we're likely to find that the taxpayer that we are dealing with is at least a higher rate taxpayer. And how therefore do we get either the higher or additional rate relief for such taxpayers? Very simple. That when it comes to computing the tax liability of the taxpayer, we extend both the basic and, if necessary, the higher rate bands by the gross amount of the personal pension contribution. We extend those bands by the gross amount of the personal pension contribution. So in our example, therefore, the bands would increase by the gross contribution of £1,000, so that our bands would now become, instead of a basic rate band limit being 31,785 at 1,000, 32,785. Instead of our higher rate band limit being 150,000 at 1,000, and we have £151,000 respectively. So we already know from the work that we did in Chapter 2 and the work that we did in Chapter 9 how to deal with the contributions made to pension funds by both employees, individuals and employers, whether those contributions are made into either an occupational pension scheme, probably the easiest of the two to deal with, or otherwise into a personal pension scheme there. Just go back and recap what we have said and look at what you did in Chapter 2. If you can't remember the personal pension contribution issues, go back and remind yourself of that if you need to, and also what we saw there in Chapter 9, before we then go over the page and progress and deal with this so-called annual allowance limitation placed upon the tax relief that the individual may benefit from in terms of the contributions into a pension fund, and also very briefly and very limited indeed issues pertaining to the lifetime allowance. So having reminded ourselves in section 1 of how tax relief is achieved in relation to the contributions made into a pension fund, either by the individual or by an employer, the only new element coming in, so far as we're concerned, is this issue about the annual allowance, and a little later on at the end of these notes about the lifetime allowance. What we know is that in relation to the contributions made into a pension fund, there are no limits placed on the employer contribution. The limitations placed on the individual's contribution restricted to the taxpayer's relevant earnings. What were the taxpayer's relevant earnings? Earnings, of course, from either employment, if you're an employee, your trading profit, if you're self-employed, and if you are either, that may be topped up with net rental income from furnished holiday lettings. Now, we put together the total pension input. Now, the AA, this annual allowance, determining the total pension input allowed for tax relief each year, and that's where this AA comes in, this annual allowance. This will determine of that total pension input that is allowed for tax relief, of that total pension input, how much will be allowed effectively for tax relief. The AA limit that we have for both the 15-16 and the 14-15 tax years has been set at a cap of £40,000. That's a reduction in what went before it, because in 12-13 and 13-14 we had an AA limit of 50,000. Those numbers, as you'll see here, provided to you on your rates and allowances pages in your examination. If the AA for a year is not fully utilised, so the contributions, the gross contributions made into the scheme in terms of the total pension input, is lower than that AA limit, be it the current 40 or previously the 50,000. If we do not fully utilise the AA, and the taxpayer was for that year a member of a pension scheme, then it is possible to carry forward any unused amount of AA for 3 years. Now, how we use that unused AA in conjunction with the current year's AA limit we'll see in a moment's time. Right. Although tax relief is given on pension contributions up to the level of relevant earnings, as we know, so talking about individual contributions, that is, of the taxpayer for a tax year, if the tax-relieved contributions exceed the AA, including any unused allowance brought forward, that, remember, was brought forward from the previous 3 years, and when it's brought forward from the previous 3 years, it is used on a first-in, first-out basis. So we go back and use the, and it's good news for the taxpayer, use the oldest unused AA first of all. So when we look at a payment made into the pension scheme in the 15-16 tax year, then we know that for 15-16 our limit is £40,000. If we were to go over that 40,000 in terms of the gross contributions made, then having used firstly the AA limit of the current year, there 15-16, we then go and use up unused AA figures from the previous 3 years on a first in, first out basis. Well, going back therefore 3 years from 15-16, would take you to 12-13, 13-14 and 14-15 would be the 3 years for which we would then be able to use up any unused AA in those previous 3 years. That would be the pecking order. Now, let's see how that will apply in terms of example 1. Just one point to pick up on at the last bit of this sentence here, that if you go above what is your AA limit in relation to what's the current year plus the unused AA brought forward from the previous 3 years, if you go above that, then there will be an AA charge chargeable to income tax at the taxpayer's marginal rate. Now, that we see in section 3 in note 3 below. We'll come to that in a moment. What we're looking at here is how do we work out what will be, and look at example 1 now, what will be the total pension input allowed for a taxpayer in a tax year. And example 1 asks us to compute that total pension input allowed for our taxpayer Aston for the 15-16 tax year. Right, so in 15-16 therefore, what is our AA limit? What is our AA limit? Our AA limit will be £40,000. Now, we want to know what the total pension input allowed will be. So we know for the year we've got our annual allowance of 40,000 before then starting to use up any unused annual allowance brought forward. Now, it's brought forward from the previous 3 years. We've already indicated here what those 3 years will be, starting with the 12-13 year. Remember, we use it up on a first in, first out basis. Okay, so back in 12-13, what do we have? Back in 12-13, the contributions were £62,000. What was the AA limit back in 12-13? Back in 12-13, the limit was 50,000. What was the gross contribution? 62,000. Therefore, nil. There's no unused annual allowance brought forward from there. In 13-14, the contributions made 30,000. In 13-14, again, what was the AA limit? It was 50,000. 50,000 minus 30,000 equals 20,000. So we've got unused annual allowance brought forward of £20,000 from 13-14, nothing from 12-13. What do we have in 14-15? Now be careful. Remember that in 14-15 there we have the reduced AA limit. That reduced AA limit was down to £40,000. What were the gross contributions made? 25,000. 40 minus 25 will equal 15,000. So let's just see what unused annual allowance brought forward there is. 12-13, nil. 13-14, what do we have there? 20,000. Pardon me. And 14-15, finally, we've got 15,000. So in which case, we have in total this year's figure 40, nothing from 12-13 brought forward, 20,000 and 15,000 brought forward respectively from 13-14 and 14-15. So we would have a total pension input allowed, 40 plus 20 plus 15, £75,000. Now the next question is, although that is the maximum figure, would we be able to get tax relief in relation to that? Look at your relevant earnings. We know that so far as an individual is concerned, Aston had made the following gross amount of contributions into his pension scheme. We are limited in terms of pension input by the individual to one's relevant earnings. And Aston had an annual salary of £120,000. Well, 75,000 there is well within your relevant earnings limit so far as the tax year is concerned. He's got a salary of £120,000. We could have gone that high. But had we gone above, or if we go above 75,000, there would be, as we see in section 3, what we call an AA, an annual allowance charge. But the total pension input allowed for Aston for the 15-16 tax year will be £75,000. Now just take a moment to review through that, if you would, before we progress this example just a little bit further. Again, go to the answer in the back. You'll see the first part of the answer again calculates what that maximum gross contribution is. I'd just like you to stop at that point, because we then add a little bit more into the answer, and I would wish to talk you through that and explain if we did make a contribution in 15-16 and it was less than 75,000 in gross form, then all of that would be allowed. But what would that then imply about any carry forward figures into the next year and possibly into the following year? So just have a little review through the calculations we've done. Check it out with the answer in the back, but again, just confine that review of the answer to the calculation of the maximum gross contribution. Okay, well, looking at the answer, you'll see a repeat of the calculations we just went through. We know that our AA limit for the 15-16 tax year is 40,000, and out of any contribution made in that year, we use up that year's AA limit first of all. Only if we go above that figure, here 40,000, do we then start to use up any unused allowance brought forward from the previous 3 years. That would be used up on a first in, first out basis. However, there was nothing from 3 years ago, 12-13. There was £20,000 in 13-14 and just £15,000 in 14-15, giving us the maximum gross contribution that would be permitted without any annual allowance charge arising, amounting to £75,000. We also had to check, of course, that that would be an allowable contribution, where we're looking at restrictions on the contributions that will be available to be made by a taxpayer in relation to their relevant earnings. 75,000 was less than Aston's annual salary of 120, well, therefore within the relevant earnings limit. So, as we've just seen, the current year's AA limit would be used first, that was 40,000, and then the unused allowance brought forward on a FIFO basis. So, let's now suggest a certain contribution being made in 15-16. So if we now assume that in the 15-16 tax year, that actually Aston made a gross contribution of 55,000. Now very clearly, £55,000 is going to achieve tax relief and without any AA charge arising. First of all, 55,000 is less than the relevant earnings limit of 120,000, so it will qualify for relief. What would it then utilise? All of the 15-16 AA of 40,000, so that would be used first, followed by we would be using 15,000 of the 20,000 unused AA brought forward from 13-14. So if we contributed 55,000, we would use all of that 40,000, and we would use 15,000, totaling 55,000, out of the 13-14 year. That therefore would still leave us with £5,000 to carry forward from the 13-14 year. Again, what we see is that 55 is less than 75, it's less than 120, tax relief would be available and without any AA charge. We also now see the position going forward from 16-17 would be that we would, going forward to 16-17 I should say there, what we would have is unused annual allowance brought forward from 13-14 amounting to £5,000, 14-15 that is untouched at 15,000, and of course we've just come through the 15-16 year. Do we have any unused annual allowance from there? No, we don't. If we made 55,000 gross contribution, the first figure that was used was that 40,000 limit for 15/16. So, putting that into the narrative statement, the remaining £5,000, here's your £5,000 from 13/14, would be carried forward for one more year to 16/17. Yeah, when you look at 16/17, in terms of any unused allowance brought forward that would be available for use in 16/17, you could only go back 3 years, and that would take you back to 13/14. So yes, the remaining 5,000 would be carried forward for one more year for 16/17. Right. If we now move into the 16/17 tax year and assume that a gross 30,000 payment were to be made, then how would you get tax relief? Well, no problem. The 30,000 payment is within the 40,000 annual allowance limit that we'll assume remains constant for the 16/17 year, so there'd be no unused allowance brought forward to be utilised from any earlier years. So the 30,000 payment within the 16/17 AA limit, that is what you use first of all. Now, what would that mean going forward into the next tax year in terms of what would be available? Right. If we were to go forward to the 17/18 year, then from 17/18 we could go back as far as 14/15. That means that that £5,000 that had been brought forward into 16/17, that was the last year in which you could have used it, and it is no longer available in relation to contributions made in the 17/18 tax year. It's too old. It's more than 3 years ago. So what would be available, therefore, in relation to 17/18? In 17/18, we would firstly, of course, use that year's AA. But after that, in 17/18, after that year's AA limit had been used, there would then be unused allowance brought forward for use as follows. Right, in 17/18, go back 3 years, that takes you to 14/15. What do we have as unused allowance brought forward from 14/15? There we go. It's still the £15,000. So we got 15,000. In 15/16, nil. We used up all of the 15/16 annual allowance limit when we made the gross contribution of £55,000 there. So there's nothing there. What did we just do a moment ago in 16/17? We made a 30,000 gross contribution. That is less than the 40,000 AA limit, and therefore we have £10,000 from that year. So when we make the contribution in 17/18, what would be the total pension input allowed for that year, in addition to the 40,000 for that year, 15,000 brought forward from 14/15, 10,000 brought forward from 16/17, that's another £25,000 of unused allowance brought forward from the previous 3 years. Add it to your 40,000, £65,000 would be the maximum amount of gross contributions available for relief without an AA charge within the 17/18 tax year. Right. Take a few moments, therefore, to digest what we just said, review again through the statements made there and the calculations that we have performed to make sure that you're happy with where those numbers and statements have come from. Once done, we'll then move through to the final part of this example, well, the final main part anyway of this particular lecture, and that is to look at the AA charge. So pause while you review and then join us again to look at the AA charge. Okay, this annual allowance charge, therefore. So, if the total pension input for the year exceeds the maximum gross contribution, the excess is subject to an AA charge by treating it as additional non-savings income of the year. So let's take that sentence apart. Firstly, the total pension input. That is a combination of any gross amount of contribution made by the individual taxpayer and, if any, the contributions, which will be gross, made by an employer into the pension scheme of the individual. So we look at the total pension input for the year. Now that exceeds the maximum gross contributions. Now what's the maximum gross contributions, as we've just seen, using our AA limits? That's the AA limit of the year plus any unused AA brought forward from the previous 3 years, using it as we saw on a first in first out basis. So we've gone above that AA limit figure, that maximum allowed in terms of achieving tax relief, then there is an AA charge. Obviously, when looking at contributions made by the individual, we must also be governed by the limitation of relevant earnings. We can only contribute up to our relevant earnings figure. Right, what have we got then in illustration 2? We're told Villa has a trading profit assessment, so self-employed, there is no employer, so there's no possibility of an occupational pension scheme. That means that the only contributions that Villa may be making would be into a personal pension scheme. What are we told about Villa's trading profit? The assessment for the 15-16 tax year is £250,000. So there is the taxpayer's relevant earnings, £250,000. Self-employed, so the contribution can only be into a personal pension scheme. There is no employer, there is no occupational scheme that the individual could be paying into. And we're told made his first contribution into a personal pension scheme during the year of £70,000. Now again, be careful, they're telling you not the amount that was actually paid in, but the gross amount of that personal pension contribution. Remember that you get basic rate tax relief at source in relation to your personal pension contribution. So actually how much would have paid in? Only 80% of that 70, so 80% of 70 would be what, £56,000. That is what Villa would have paid into the personal pension scheme. Basic rate relief given at source, 20/80ths of that would be another 14,000 paid over by HMRC, giving us in total a gross contribution of £70,000. Right, what have we got to do with this information? Compute the annual allowance charge that will arise in 15-16. So you're told there's going to be one. And prepare the income tax computation for Villa, showing his income tax liability for our tax year 15-16. Right, look at the information we've already picked up on. We know that Villa has relevant earnings of £250,000, the individual's trading profit. So in which case a gross contribution of £70,000 will all attract tax relief. However, as Villa was not previously a member of a pension scheme, remember we highlighted there this was the first contribution into a personal pension scheme, as he was not previously a member of the pension scheme, he will have no unused allowance brought forward. No unused allowance brought forward. Now if he had made contributions, like in section 2 before this, you know how you would work out the unused allowance brought forward, and you could add that to your AA limit of 40,000. That is not an issue here because there is no unused allowance brought forward. So that means we'd now be facing an AA charge of 30,000. Where does that come from? The gross contribution 70,000, the AA limit 40,000, with no unused AA brought forward from any of the previous 3 years. We're looking at an AA charge of £30,000. Right. As Villa has contributed, as we said, into a personal pension scheme, not an occupational scheme, what it also means in relation to the income tax computation and the calculation as required of the income tax liability is that Villa's basic rate and higher rate band limits will be increased. We must extend those basic and higher rate band limits by the gross contribution. What is that gross contribution? It is £70,000. So before you put pen to paper on your income tax computation, you must note, if it's a written question anyway, the revised basic rate and higher rate band limits. So the basic rate band limit that would have been 31,785 is now increased by 70,000 to 101,785. And the higher rate band limit of 150 increased again by 70 up to 220. So it is by reference to those basic and higher rate band limits that you would now be computing the income tax liability of Aston for the tax year. As we've already made the point, it was a personal pension scheme contribution. Those, of course, are paid net of basic rate relief at source, so you would actually have made the payment of 56,000 as we computed up there. He put in 56, HMRC contributed the remaining 14,000. Basic rate relief achieved at source. Okay, so let's now put together the income tax computation for the tax year. So, Villa income tax computation 2015-16. Trading profit £250,000. We have worked out the AA charge £30,000. What do you say we would do with that? That AA charge by treating it as additional non-savings income of the year. So if you were doing your analysis columns here, as well as a total, you'd have non-savings. The 250,000 trading profit is non-savings. The AA charge is non-savings. That would go into your non-savings column. We need to know what type it is, simply in terms of the tax rates that will then be applicable. So that gives us net income of 280, less personal allowance, nil. Now, again, we've got to make sure that we've correctly determined that the personal allowance is actually nil. Now, you'd probably think, well, with net income of £280,000, well, of course it is, but be careful. Let's just have a little look at Note 1. In terms of Note 1, we must calculate Villa's adjusted net income. Now, how do we calculate the adjusted net income? What we must do, of course, in calculating that adjusted net income is to have a look at the net income of the taxpayer that would otherwise have arisen. It's £280,000. And deduct from that the gross amount of personal pension contributions. So Villa's adjusted net income, for purposes of computing his personal allowance, comes out at 210. That being the net income, 280,000 minus the £70,000 gross amount of personal pension contributions. Now again, if you can't remember that calculation, go back to Chapter 2 on our Introduction to the Income Tax Computation and look at how we calculate the adjusted net income. You'll find it there. We should know it. Now, 210, it clearly exceeds 121,200. And that would mean that when you get to 121,200, as you should know, the personal allowance will have been reduced to zero. You start to reduce that personal allowance when adjusted net income exceeds the income limit of £100,000. You reduce it on a £1 for every £2 of income in excess of that adjusted net income figure at income limit of 100,000. So by the time you get to 121,200, all of the personal allowance has gone. So yes, there is no personal allowance, but show you're working for that if you're dealing with a written question in section C. So with no personal allowance to deduct, the net income is the same as the taxable income, and it is 280. As you then use the tax bands, remember now all of this income is non-savings. It's all non-savings income, but also remember that both the basic and higher rate bands limits have been increased, extended by that £70,000 gross amount of personal pension contributions. So the basic rate band is 101,785. That therefore 101,785 at 20%. The higher rate band limit, remember, we extended to by 70,000 up to 220,000. So from 101,785, that figure there, up to 220, that will be an additional 118,215. At 40%, that is the higher rate band for non-savings income. Calculate the tax. We have now dealt with our basic rate and our higher rate bands. We've gone up to £220,000 of taxable income. We have 280, leaving in the additional rate band 60,000 to be taxed at 45%. Put it all together and you've got your income tax liability. Right, have another look through that example. Make sure again that you are happy with that, and you see how it is that we have determined the AA charge and how then we tax that AA charge within the income tax computation. Again, most likely seeing it in the context of a personal pension contribution, which demanded, as you've just seen, the extension of your basic rate band and higher rate band limits. Check through that for a moment, and then we'll finish off with just a little bit of a final note on that so-called lifetime allowance. So having paid into your pension fund for maybe many years of your working life, if not all of your working life, what then happens when the taxpayer takes their pension? Now, just one other point probably worth mentioning here, that they'll only be able to take their pension when they are a minimum age 55. You've got to be age 55 before you take the benefits of your pension. When the taxpayer takes their pension, minimum age 55, then what do they get? They can take, here's more good news in terms of tax relief, a tax-free lump sum of 25% of the pension fund may be taken. Now, up until 1516, previously, the remainder would have to be used to buy a pension annuity. So if you've got a pension fund of, say, let's pick an easy figure, £100,000, 25% of that, 25,000, could be taken as a tax-free lump sum, and the remaining 75,000 would have to have been used to buy an annuity. And what that annuity is, as you should know from, no doubt, other studies, you put your 75,000 in, and that gives you, at a rate we determine now, a guaranteed return on that for the rest of your life. Now again, with interest rates being so low in most economies for the last several years since the financial meltdown in the late 2000s, then those annuity rates are very low. So you might get something like between 5 and 6%, maybe probably now 5% as an annuity rate. So that's not a huge amount. Now what would happen is you'd spend your 75,000, you get your 5% annuity there on, and if you died 3 years later, that's it, gone. Now you hope, of course, you'd live for a lot more years and get lots of 5% each year, but it's going to take a long time to get a payback in relation to that money. So what they did for 1516 onwards is to bring in a new and better system in terms of how you may gain that tax relief. So whereas previously the remainder would have to be used to buy a pension annuity, the taxpayer may now withdraw the balance of the pension fund as taxable income whenever they wish. So each year you could take out an amount of that 75,000, and it would be treated as taxable income, to be precise, as non-savings income of that tax year. And of course it would then be taxed at whatever was your marginal rate of tax. So if you want to take the money out in order to invest it in your own choice of investment, buying a property or whatever there, then you're able to do so. It doesn't have to be used to buy an annuity. So a bit more flexibility has been brought there into the pension market, so far as the UK is concerned. Now, we just said there that imagine that the pension fund was £100,000 and how we could then take the money out. But when you come to take that pension, in addition to, as we note here, our annual allowance which has limited the tax relief available on the yearly contributions made into the pension fund. So there is also now, when you take that pension, a lifetime allowance, and that lifetime allowance limit is 1.25 million, applying to the value of the pension fund that has been built up as at the date the taxpayer takes their pension. Now then, some of us, most of us, can only dream of having built up a pension fund worth £1.25 million. There are not going to be that many taxpayers, I'm certainly not amongst them, who've been able to build up that amount of pension fund, or indeed anything like it. But if you had a pension fund that value at time you took your pension exceeded 1.25 million, then this lifetime allowance comes in, and if the fund value exceeds this limit, then an income tax charge will arise on the excess, dependent on how that excess is used, i.e. whether you take it out as cash now, cash later, or whether it's used to buy an annuity. You don't have to worry about that, because that's not within the syllabus. All you've got to be aware of is what the basic lifetime allowance limit is and what it means. That if you built up a fund in excess of the lifetime allowance limit, currently, well, for 15-16 tax year anyway, 1.25 million, then depending on how you take that pension, there will be a further charge in relation to the value of that fund in excess of the lifetime allowance limit. Okay, again, as at the end of each of these chapters, what you'll know is you can review various parts of the Finance Act 2015 technical article was written by the F6 examining team. Here the bit, of course, that pertains to pension schemes. And again, as ever, there's a practice question at the end of these course notes that you will be able to attempt, which I would recommend to you therefore. Now at this point, we've basically dealt with all of the issues that we need to look at in terms of the preparation of the income tax computation of the taxpayer for our tax year, the 2015-16 tax year, and how then we calculate either the tax liability or the tax payable, either the tax liability or thereafter the tax payable for that taxpayer. What we see from now on are the various other taxes that will come into play so far as your exam is concerned. The next chapter, a relatively short one, looks at the relatively small area of national insurance contributions that are payable in relation to your earned income, be that employment income or be it your self-employment income, your trading profits. After that, we'll be looking at, for the individual, the taxation of chargeable gains. We'll then move in to look at corporate tax. Next, really, to income tax, corporate tax is the next most important taxation so far as you are concerned. We'll look at corporate tax. We'll also be looking at, when we look at corporate tax, the fact that companies will pay corporation tax on both their income and their gains. An individual, as we'll discover in the forthcoming chapters, will have a separate income tax liability and a separate CGT liability. Companies don't have that. Companies have a corporation tax liability because they are charged to corporate tax on their income and their gains. And in dealing with gains for companies, there's a few other special rules that we need to look at. So our capital gains knowledge is based on looking at the CGT information for an individual and how gains are charged to corporate tax for a company. So there's two sections, two lots of chapters here that cover capital gains, one for individuals coming up very soon and the other for companies. After we've looked at corporate tax, there's then two other main taxes to look at, each of which will command their own question, probably in section B of the paper, and may also of course have individual objective testing questions in section A. And those areas will be looking at VAT and inheritance tax, value added tax, VAT, and inheritance tax, IHT there. So all of that awaits us in the remaining chapters. But next on our agenda will be to look at national insurance contributions.